in just 2 days. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, policymakers are in crisis mode as the government's toughest test of the year sparks alarms. And many experts have been warning this day was coming, and on Wednesday, it's finally here. And if you think it has anything to do with the Federal Reserve, well, in this case, it doesn't. Plus, we're seeing a major economy continue to slow down. We're going to show you what's behind their slowdown and why this is coming to the U.S. economy in the near future. And we're also seeing Wall Street put on one of the biggest bets in history on something nobody thinks is going higher. And if you're wondering what we're doing at Evergrande today, well, China's property crisis just hit a new low. Now let's head over to Bloomberg, where we picked our story up with the headline, German economy shrank in the third quarter amid recession threat. Now this is interesting because we've been talking about the German manufacturing PMIs or purchasing manager indices, and yet they continue to show that the German manufacturing sector is not just in a recession, but in an outright depression. And we've made the case that within months of wherever the manufacturing PMI goes, the services sector follows, and yet many people said, no way. And now we're finally starting to get signs of recession. And this time, what they're calling the catalyst, well, this is the same problem Americans are soon to face. And gross domestic product fell by 0.1% from the previous 3 months, less than the 0.2% drop economists expected. But this is citing, get this, a pullback in household spending. Now, of course, we know this is coming to the U.S. We've talked about all the reasons why, with the pandemic stimulus ending and credit card minimum payments rising and student loan repayments resuming. But that's not what the issue is with the German economy. And of course, we're going to add the list of things that are about to affect the U.S. economy. The data underscores Germany's struggle to bounce back from an energy-induced downturn last winter that was followed by 2 quarters of stagnation or minimal growth. Now, notably, this is energy-induced now we're hearing, because when you think about, consumers, what are their 3 main spends on? Well, they have rent, they have food, and they have energy. Now, rent is something that doesn't fluctuate too much, and yes, we know it goes up over time. We know that food prices can fluctuate, but generally they're somewhat stable. The problem is energy prices can spike in a big way, and when that happens, it cuts back on discretionary spending. So what we're hearing about the German economy is that high energy prices have really curtailed household spending on the discretionary side, and that makes perfect sense. The issue is it's coming to America too, and let's take a look at this chart, because I want you to see that in periods where you have high inflation that's followed up by high energy prices, you usually get a collapse in demand. And sure enough, you go into the dot-com bubble, you see energy prices rising here in red, this shown as West Texas Intermediate, against the consumer price index in blue on a year-over-year rate of change, and those higher energy prices were not able to be absorbed by consumers, led to a crash in demand. You see that here around 2006, 2007, rising energy prices become just too much for the American consumer. Of course, we know during the global financial crisis, energy prices soared, and so did inflation, until it broke the back of U.S. consumers. But here again, you see around 2012, 2013, here again in 2015, around 2019, and we're seeing again, except this time energy prices are rising, and we know for a fact that U.S. consumers can't afford it. It's going to lead to a further decline in demand at a time of the year. We've got the holidays coming up. This is a big time for many retailers to get in the black, and this is going to be a big problem because U.S. consumers are getting to the point where they're tapped out. And as we mentioned, China's property sector now hitting new lows. We're going back to Evergrande because they're at a liquidation hearing that got delayed in the last adjournment. And we see a judge in Hong Kong's High Court adjourn the proceedings on December 4th in the latest series of delays that begin since last year. And she said this is the last adjournment. Evergrande must have a concrete restructuring proposal by the next hearing. Otherwise, the court is very likely to issue a winding up order. Now, if you've never heard what a winding up order, it's not a little toy that you wind up and send down the hallway. What this means is you go straight to liquidation. And you think about the property sector. We talked about Country Garden. They're facing the same issue of restructuring. And if you start to get a tidal waves of liquidations, particularly court ordered, it's going to send panic in investors' mind. Of course, we also know just how closely linked China's property sector is to its banking sector, as you're about to see. An Evergrande saga has added more uncertainty to China's property debt crisis as it heads into its fourth year amid record defaults. The problems began in 2020 when authorities laid out the 3 red lines, which set to leverage benchmarks for builders. And really what it did is it curtailed the extension of credit to the property sector. Of course, we talk about anytime you blow a bubble, whether it's central bank induced, government induced, or just money printing induced, and you curtail the growth of it, there is a certain point where the bubble bursts, and we're seeing it now in slow motion. And by the end of the next year, Evergrande had defaulted, and in March this year, the company laid out details of its planned restructuring that called for offshore creditors, get this, to swap debt for new securities. You're thinking equity, stock, you bet. Do you think they want it? No way. And creditors and borrowers often prefer negotiated restructurings to court-ordered liquidations because in a court-ordered liquidation, everything must go. Price gets slammed to the floor, and in a negotiation, they have a chance to recover more of their money. That's why investors love that over the other one, and given they can exert more control over the process. But the risk of a winding up rose recently after a shock from Evergrande in late September when it scrapped creditor meetings at the last minute and said it would reassess its proposed restructuring. In this case, the courts could very easily send Evergrande into liquidation. This would put pressure on other companies like Country Garden, who are going through the same process, to tell them, hey, look, if you keep screwing around with this, we'll just put you into forced liquidation. And again, if you want to talk about mass exodus from investors, if they see that they're going to get even less of their money back, you're going to watch money vaporize out of China's property sector in a big way. And yet, such an event could further expose the impact on financial institutions. This is what we've been making the case. Banks may need to recognize losses. This would be a big issue of bad debts if a liquidation order is issued, which could result in deteriorating financial situation. Again, now we're talking about breaking the back of the banks here in China, and that is a serious issue and a major one that they just can't afford to deal with. And yet, at the same time, we're seeing effects of the Federal Reserve's rate hikes start to spread throughout the global economy, and it's causing major issues, not just in the fact that we're not creating enough dollars for companies like Country Garden and Evergrande to pay on their dollar-denominated debt. We're causing major issues for central bankers all over the world. And here you can see the strong dollar keeps rate hikes on the table for Asian central banks. Now, I want you to understand here, what is the catalyst here? Because as the Fed raises rates, the belief is, and we, of course, have been making the case that this is not true, but it's yet common belief that the Fed has control of the dollar, and when they raise rates, the dollar goes up in value. Well, it's not exactly what causes it, and we'll show you, but the issue is it puts downward pressure on other currencies. And what does that cause in their countries? Well, if you said inflation, you got it right. As central banks in Indonesia and the Philippines already raised interest rates over recent weeks and signaled they could tighten again. And other Asian monetary authorities, including India, are so far choosing to run down their foreign currency reserves instead. But economists say there's a limit to how long that continue. And either there's two things that has to happen. Either the dollar needs to come down in value, or all these other central bankers need to hike and attempt to bring the value of their currency up. Or if not, something in the system inevitably breaks. Of course, we know when that happens, the Fed comes around and extends massive unlimited swap lines. They tend to start cutting rates. We know the Fed is on a path that is completely unsustainable. And yet on Wednesday, we're also going to hear from them on top of the biggest test the U.S. government will face this year, and everybody, including policymakers, are on pins and needles about what's going to happen. The double whammy of a weak currency and inflation resurgence could see some central banks in Asia returning to tightening. Persistent and outsized depreciation pressures could convince central banks to resume rate hikes at a time they're worried about crashing their own economy. And yet, here we have on this chart the federal funds rate against the nominal broad U.S. dollar index. Of course, everybody claims that when the Fed raises rates, the dollar goes up. Well, you can see that here in 2006. The Fed was raising rates, the dollar went down in value. Absolutely no correlation at all. In fact, the Fed's cutting rates, and then the dollar goes up in value. And starting in 2012, we see the dollar go on a long rally. Meanwhile, the Fed's not hiking rates until 2016. And lo and behold, the Fed starts to cut rates around 2019. The dollar still rallies before it comes down, and lo and behold, no surprise, the dollar leads the Fed by a wide margin here, suggesting, as we normally do on this show, that there's no relationship. But what the relationship has to do is with global trade, because when the global trade expands, well, more dollars are created. And when that happens, the dollar weakens in values by design of how the global monetary system works. So when global trade slows, well, what should happen to the dollar? Well, if you said it should go up, then you got it right. And here we can see imports of goods and services in blue shown on a year-over-year rate of change. Now we're going to keep against the nominal broad U.S. dollar index in red. And sure enough, look at this. During the global financial crisis, global trade comes collapsing down, and the value of the dollar goes up. And it's a simple reason why is because there's a large amount of offshore dollar-denominated debt, so much we don't even know how much it is, and you need dollars to pay on it. So what happens is you do need global trade to expand to create enough money if you're thinking to handle growth and pay on the debt. You've got it. You're getting it. This is perfect. And so when you see global trade slow, the value of the dollar goes up because there is a greater demand for it to pay on all the dollar-denominated debt. And yet we see that relationship happen over and over again. Here we can see going into the pandemic, global trade slows, dollar rallies. Here we're seeing it now, global trade slowing, dollar rally, nothing to do with the Federal Reserve, even though they think it does. And yet middle-class Americans are rattled by the Fed's fight against inflation, and sure enough, because they're hurting in a big way from borrowing costs, we're finally, we hear about the Federal Reserve talk about these monetary lags that are long and variable, they're uncertain, because there's absolutely no way to measure them. What matters is when the Fed tightens financial conditions, or more accurately, causes banks to tighten financial conditions by inverting the yield curve, what it does is it constrains the creation of money in the system. Now, it only is a matter of time, and this is what we don't know in terms of the long and variable lags that the Fed is referring to, how long it takes the constraint of credit creation to dry up the existing money in the system where it starts to cause pain. And slowly, we're seeing more and more signs of that, not just around the world like we've seen in China and in Germany, but we're now finally starting to see signs here at home. In the Harris poll, in the latest series taken for Bloomberg over the past year, 57% of middle-class respondents said higher borrowing costs were having a negative impact on their household finances. That strain contributed to a downbeat sentiment about pocketbook issues. Some 44% said they're stressed about the economy, up 40% from a year ago and 39% in March, suggesting there are two issues here. One, inflation being a problem, which we'll look at, and the second one, which is the fact that higher minimum payments, higher interest rates are causing debt services costs to rise, and thus keeping many Americans from maintaining the lifestyle that they want to. If the economic story for much of the past 2 years has been about the impact of inflation that hit a 40-year high in 2022, a growing part of the pain for U.S. households is the side effects of the Fed's medicine. On credit cards alone, here we can see the impact of higher borrowing costs on minimum payments. Consumers paid a record $130 billion in interest and fees last year. And of course, we know that consumers are sitting at record high debt levels at a time when interest rates are really high, meaning their debt services costs are high, and it's got to come out of their other part of the budget. Again, we come back to rent, food, and energy. We now have energy costs rising. We have interest costs rising. Again, less discretionary spending. You want to talk about why Americans are getting less confident in the economy? It's because they can't enjoy life the way they're used to. And sure enough, we know inflation is taking a big bite out of this as well, as the consumer price index here shown in blue against total compensation in red, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And what we see is total compensation growth is lagging inflation. So we already know, on top of all these factors, that of course inflation is an issue, and households, they just can't keep up, and they're finally having to make hard decisions here, and that's causing them to worry about the jobs market, because they're seeing a lack of demand. They're seeing that their employment, they're not seeing all the new orders, they're seeing all the backlogs go away, and it's only a matter of time before they wonder when their job is next to go. Now, as we head into our lead story here, we want to set the stage. Until that, we got to head over to Japan. Because today we see the yen rally sharply on reports that the Bank of Japan will lift the yield cap. Now, if you're wondering what the yield cap is, it means they're suppressing the movement of their long-term bond yields by buying, think of it like QE, and keeping them capped at a certain level. So rumors are spreading that, of course, they're going to raise that, and if they do, it has an impact on yields all around the world, suggesting that perhaps today's downward movement in treasury, or upward movement in today's treasury yields, has some impact to do with Japan. As Japanese policymakers are considering letting the yield on 10-year government bonds push above 1%. The yen, which had traded lower on the day prior to the news, immediately jumped roughly 0.5% in a matter of minutes, following the report of a potential tweak to the central bank's policy of yield curve control. Of course, why would the central bankers of Japan do this? Well, they would do it for one major reason, and that is to keep their currency from free falling. What they don't realize is that it has everything to do with global trade. You can tweak yield curve control, you can make changes to your bond purchase programs, or whatever you want to do. It's not going to change the long-term path of their currency until the global economy turns around. But because we're talking about interest rates here, and we have a Fed meeting coming up, but the big test on Wednesday, nothing to do with Japan, nothing to do with the Fed, but everything to do with the bond market. As the big bond market event Wednesday is at the Treasury and not at the Fed. The so-called quarterly refunding announcement will reveal to the extent of which the Treasury will ramp up sales of longer-term debt to fund a widening budget deficit. Though securities have been tumbling for weeks, even amid signals from the Fed officials, they're at or near the end of rate hikes. So one thing we've seen is the Fed calling for higher interest rates on the long end of the curve on kind of as an incentive for them to stop hiking rates. And as a result, investors and speculators have piled into short positions, driving rates higher as much as they possibly can. And yet, here we're facing the problem with the U.S. government having to issue more debt. Now, what you see is when the government issues new debt, they always issue it at the short end of the curve, or at T-bills. And when those bills renew or come due, they will refinance some of that at longer term yields. Now, the issue that's happening here is because of all the massive deficits, we have to increase, or at least they're looking at increasing the amount of long-term debt issuance. And yet, what is the popular belief is that if you issue more debt, rates have to go up. Well, in history, there's absolutely zero. I mean, talk about no evidence of something. There's really no evidence that that's true at all. And the South has sent yields to the highest level since before the global financial crisis, making longer-term treasuries more costly for the government. Investors are eager to see whether officials maintain the pace increase in longer-term debt sales that they announced in an August plan, because bumpy auctions of some securities in recent weeks have only increased that focus. Again, the issue here is that traders and investors, they all believe that more issuance leads to higher yields. We made the case that not only is there no evidence, there's zero evidence of this, but the more the government borrows out of the economy, the more it takes away from private industry. We're kind of already seeing that effect now. It's only going to get worse and cause what in the end? Well, there'll be lower yields, not higher yields, and nothing to do with issuance at all. And yet many bond dealers predict a refunding size of $114 billion, representing the same cadence of increases per each refunding security as laid out in the $103 billion August plan, which marked the first step up in issuance in more than 2 years. An alternative view predicted by several large dealers. Now keep in mind, the U.S. Treasury does actually poll and ask the dealers what they think. And of course, if you don't believe that the U.S. Treasury is listening to them, well, they are, because they're the ones that take the excess from the auctions and have to sell it. It matters what these dealers say. Large dealers would prefer a smaller bump in longer-term debt given the recent surge in yields and greater reliance on bills, which we know, of course, the monetary system is desperate for, that mature in less than a year or. And some see this tweak as potentially combined with a signal that further increase in long-term sales isn't certain for the next refunding. And of course, that means all eyes, not on the Fed on Wednesday, because we already know what the Fed is going to do. They pretty much made it clear they're not going to hike. The issue is all about the Treasury and how much, if they even do raise the limits here, or if they start to realize that the real problem in the long term in the bond market has to do with a shortage of T-bills, and maybe they'll just maintain it. Well, we'll soon find out. But you start to think about the Fed here. Do you really think the Fed wants to come out on the same day as the Treasury is announcing this and perhaps raise interest rates? If you think they do, you've got to be crazy, because there's no way the Fed wants to cause any disruption in the issuance of U.S. Treasuries. And indeed, Fed Chair Jerome Powell, a former Treasury official, and his colleagues may take interest in investor reactions to the refunding. He and others, including Dallas Fed President Lori Logan, who previously oversaw the Fed's market operations, have said the surge in long-term yields may mean less need to raise a benchmark rate, thus indicating the next meeting is an absolute pause. And while Treasury Secretary Janet Yellen on Thursday rejected the idea yields were climbing due to swelling federal debt, and I hate to say it, this is one of the few times that Janet Yellen is actually right. She's got this perfect. She knows it. Powell this month did focus on deficits as a potential contributing factor. Of course, we know he's wrong, because notably the reason we've seen 10-year Treasury yields rise is because the Fed has put so much upward pressure on yields that the longer end of the curve has been forced to follow. We know it won't last because the long end of the curve is a function of growth and inflation expectations. And yet, now all of a sudden, so if the popular belief is yields must rise, we're about to see one of the biggest bets in Wall Street history on the long bond. And on the verge of an epic showdown, demand for TLT calls explodes to record as Treasury future shorts hit all-time high. On one hand, as Goldman's derivatives traders Brian Garrett and Colin Morgan write, demand for TLT calls and call spreads exploded this week. That's because this is, quote, a cheap way to play for a snapback in bonds, suggesting that, of course, traders now believe, or some of them, that there's too many shorts in the path. No matter what the Fed does on Wednesday or the Treasury does, is yields go down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.